joining us today. My name is Paul from First Macro Capital. For those new to the channel, hit subscribe button now. You can also check us out at firstmacrocapital.com. We're an independent research firm to help individual and professional investors identify long-term cycle opportunities across multiple sectors. Going to be looking at today what the consumer confidence is telling us and what that means for further rate cuts, what one industry is telling us in the hotel sector of the overall health of the economy, along with the dollar, and what this means related to other sectors, and one sector that is poised to benefit from all of this that is happening. Just a general disclaimer, we will be making forward-looking statements. Since the most recent rate cut, we have seen the probability of further interest rate cuts by the U.S. Federal Reserve swing from almost a 50% chance of further rate cuts in December now to just 5.2% chance of further rate cuts from the Fed, and this all changed within about a 1-month time period. Essentially, the market is pricing no further rate cuts, but is this correct? Here's a look at consumer confidence, the Fed funds target rate, and unemployment. Commonly, what we see is the interest rates top out right where along the consumer confidence is topping out. When we look at the Conference Board Consumer Confidence Index, consumer confidence commonly peaks when the stock market is peaking, and then in the following weeks and months ahead, as the unemployment is troughing, we begin to see unemployment rate accelerating as the stock market has peaked with the consumer confidence. Historically, once the Fed cuts enough to fix the yield curve from being inverted to no longer be inverted, just like in 2001 and 2007, we saw a recession in the following months ahead. We don't think this recession will be as severe as 2008 because we don't want to get caught up with anchoring to the most recent recession. Gold has outperformed the S&P 500 when the US 10-year minus the US 3-month was no longer inverted because of the Fed cutting interest rates. Now we're back to where we were in 2001 and 2008, with our preference to be overweight gold relative to the S&P 500. Gold in this type of environment relative to the S&P 500 is poised to outperform. What about gold versus gold stocks? We always think you should have at least some portion of gold in your portfolio. That being said, which one should you choose, gold or gold stocks? Depending on your time horizon, gold stocks are positioned to outperform gold in the coming years ahead. That being said, in the near term, gold stocks may be impacted if the entire market sells off, but we'd expect them to bottom much earlier than the S&P 500 as the materials sector tends to outperform in the early stages of the new business cycle. Gold and gold stocks will bounce around with gyrations. The bottom is in for gold stocks relative to gold when the ratio bottomed in 2016. For the long-term investor, holding on here is more important to generate those multi-bagger opportunities. More important, the US dollar peaked in 2002, resulting in gold stocks outperform the S&P 500 in the coming 12 to 18 months ahead. Gold stocks are back to their 2002 lows versus the S&P 500. And if you're willing to take a 12 to 18 month view, it looks increasingly probable that gold stocks will outperform the S&P 500 as gold stocks head higher and the S&P 500 falls. The US dollar weakness and the rotation out of tech, the largest sector of the S&P 500, into commodity stocks, the world is presenting a gift to investors. And those looking for new asymmetric opportunities, you're looking right at it. This is a huge opportunity that we may not see for at least another decade. There's an old saying, you can hate if you want to, about what potentially happening with this rotation, but you'll be with me in time. Thanks for joining us. Again, hit subscribe. You can check us out at firstmacrocapital.com. We cover new sectors every month. Monthly subscription is $89 a month. No hidden fees, no hassles, cancel at any time. Sign up today at firstmacrocapital.com.